something subtle is happening beneath the surface of the housing market. Rents are quietly falling across major cities, apartment loans are approaching massive refinancing deadlines, and large institutional capital is watching the same pressure build. The question is not simply whether housing falls. The real question is who survives the transition. Within our strategy framework, we do not analyze housing through headlines or narratives. We analyze it through transmission mechanisms. Housing sits at the intersection of labor markets, credit availability, interest rates, and liquidity conditions. When pressure builds across those channels at the same time, housing becomes a delayed but powerful amplifier of macro stress. Right now, we observe several signals that align with late-cycle dynamics. Large volumes of multifamily construction were completed in recent years. Many of those projects were financed under assumptions of permanently rising rents and lower interest rates. But refinancing conditions today are dramatically different. When debt rolls forward at higher borrowing costs, while rents stagnate or fall, the cash flow equation changes quickly. That refinancing pressure becomes particularly important when the scale is large. Hundreds of billions of dollars in multifamily debt are scheduled to mature within the current calendar year. If property income does not cover the new financing costs, investors must either inject capital, accept losses, or sell. That is where forced pricing begins to appear. In our framework, housing pressure typically begins as a Phase 1 signal rather than a Phase 2 event. Phase 1 is the stage where markets still appear stable, but underlying systems begin to crack. Prices may hold, but activity slows, refinancing becomes difficult, and certain segments begin repricing quietly. We currently estimate roughly a 60 to 70% probability that the housing system remains in this slow pressure phase through late 2026. During this period, rents may continue drifting lower in oversupplied cities, while refinancing stress builds in multifamily portfolios. And if you find this type of signal-based analysis helpful, consider subscribing to the channel. The goal here is not predictions or headlines. The goal is to help you understand the mechanisms behind markets so you can recognize structural shifts earlier and make more informed decisions over time. The probability of a broader forced liquidity phase increases if three additional signals align. The first is labor deterioration. Housing stress rarely accelerates until job security weakens. The second is credit tightening, especially in private credit and regional banking exposure to real estate. The third is interest rate dynamics, particularly whether long-term yields remain elevated while borrowers attempt to refinance. If those signals converge, the system can transition into what our strategy defines as Phase 2, sometimes called the crash cascade. That phase is not driven by pessimism. It is driven by mechanical selling when financing structures fail. However, forced selling does not mean permanent collapse. Historically, those periods often create the most asymmetric repricing opportunities. Assets move from optimistic financing assumptions toward realistic cash flow valuation. Institutional capital typically waits for that reset before deploying aggressively. Before we go further, a quick note. This analysis is educational in nature and reflects macro observations within a framework. It is not financial advice or investment guidance. That is why the timeline matters more than the narrative. Our current probability structure suggests the following sequence: roughly 70% probability that the housing market remains in a slow grind adjustment phase through the second half of 2026. Around 40% probability that refinancing pressure escalates into a broader credit event between late 2026 and mid-2027. And if that stress forces policy stabilization measures, the next phase would likely involve a liquidity response that eventually resets housing affordability and investment demand. So the key observation is not that housing is collapsing. The key observation is that the financial structure around housing is tightening. And when financial structures tighten, price discovery follows. What we watch now is simple: Labor stability, credit spreads, refinancing activity, and rent trends across oversupplied metropolitan areas. If those signals deteriorate together, the housing market becomes one of the transmission channels through which the broader macro cycle moves from late stability into forced repricing. Our strategy does not attempt to predict the exact moment that shift occurs. Instead, we observe the signals that reveal whether pressure is building or stabilizing. Because in complex financial systems, the timing of the transition is uncertain, but the mechanisms that produce it are often visible long before the headlines arrive.